Second category is on expected credit loss. Now, looking at the definition of what is expected credit loss, let's just look at the title alone. That would help us. Expected, yung inaasahan, your anticipated, the likelihood or probability of a default. The default is the issuer's inability to follow through with its obligation. In yung very essence of credit, pinautang mo, hindi ka nabayaran. Hindi ka nabayaran, hindi natupad yung side, his or her side of the agreement. Default. Probability of default. No? Expectation connotes probability. How likely will this counterparty to not be able to honor its obligation? Credit. Credit is yung amount of money that you lend out or given out. It connotes exposure. Exposure at default. Ano ba yung amount of money I stand to lose? If I lend out 100 million pesos worth of banknotes, corporate bonds rather, that's my exposure if that corporate entity ends up not paying back or not honoring its obligations under the corporate bond debentures. Loss given default is the amount of money I can still recover. Let's say if there's a collateral, that loss can be mitigated by converting that collateral into cash by foreclosure and eventual sale. Or if I can generate recoveries from all other assets of the company. So expected credit loss is actually a combination of probability of default, the likelihood that the company will not be able to honor its obligations, exposure at default. How much is the total amount of money at risk? And loss given default. The proportion of that exposure at default that is highly likely to be lost in the event of a default. Their product is the expected credit loss impairment under IFRS 9. So, balik tayo dun sa classification and measurement. We have to first understand, sino ba dito sa tatlo? Debt instruments, equity instruments, tsaka derivatives. Sino ba dyan ang may pangako? Nangako yung counterparty. Sino dyan sa tatlo? Out of the three, yan ang may credit risk. Si debt instrument, hindi si equity. Kasi remember, si equity, meron siyang rights. Kung hindi ginamit ng owner yung rights niya, walang problema. Derivatives, you can make an argument, sir, may credit risk din po sa derivatives kasi may counterparty credit risk. What if the forward contract, yung counterparty ko, hindi niya tinupad yung kanyang end of the bargain? That's correct. That is also credit risk. However, for our purposes under IFRS 9 ECL, the focus is on debt instruments wherein meron kang promise of payment of principal or interest. Because of that solely payment of principal and interest, that fixed or determinable amount, that definition generates credit risk that requires us to capture provisioning for. Dito sa second question, yung business model assessment. Tatlo yung categories natin. May held for trading, merong hold to collect, tsaka hold to collect and sell. Sino dyan ang kailangan natin i-subject sa expected credit loss? The keyword here, yung hold. Kasi yung isa, kung ang value ng instrument bumagsak at kailangan mo na ibenta, wala kang choice. Bibenta mo siya, toss ka. This one, because hold to collect and sell, so basically amortized cost tsaka FVOCI. Because a portion, you want to hold it, you're exposed to credit risk if that holding results in you not generating and collecting the cash flows. So sa unang section, only those debt instruments are subjected to ECL. Under the second question of CNM, only those hold to collect, which is amortized cost, and hold to collect or sell, which is FVOCI, are subjected to ECL. Now, under IFRS 9, so ang kailangan mo lang i-subject sa ECL computation would be FVOCI tsaka amortized cost na debt instruments. Okay? There are other, may additional pa si ECL. Kasama yung exposure under PFRS 15, which is receivables, tsaka PFRS 16, which is lease receivables. So basically receivables kasama sa impairment. Also, kung merong off-balance sheet items that generate credit exposure, such as letters of loan guarantees or loan commitments. Now, there are 3 stages in expected credit loss provisioning. All instruments fall under stage 1. At initial recognition, lahat yan basta pumasa sa credit standards ng company, stage 1. So, pumayag ka na yung customer mo magbayad ng net 30 days, no, term is 30 days. As long as pinayagan mo siya, stage 1. Stage 1 are usually your good assets, but because of prudence, alam mo, eventually meron dyan papalya. So you still have to capture credit risk, credit loss impairment. And the computation of expected credit loss is probability of default multiplied by loss given default multiplied by the exposure at default. Si PD, pwedeng 5% probability. Since walang collateral, 100% ng pinautang mo, pwedeng mawala. Wala akong collateral eh. And exposure at default mo, let's just say 1 million pesos ang pinautang mo. Ang ECL mo is 5%. Ang 5% na 1 million, 50,000. Now, there is present value factor involved because this loss will happen in the future. So you have to bring them back to present value. Could be higher, let's just say 70,000 pesos. Bakit lumaki? Eh, di ba pag present value lumiliit? Ang PPV mo actually is yung cash flow. Since the cash flow will happen in the future and there's a high likelihood that you will lose 50,000, the 950,000, pag PNV mo, liliit pa yon. So that shrinkage will add up to the loss that you're exposed to. Probability weight, ito yung mag-scenario analysis ka. Pwedeng optimistic, base, tsaka worst case. For our purpose, we can ignore that. Pero, that still is being done in practice. Meaning, this one could be, ang base case is 50,000 loss. Ang worst case is 100,000. Ang best case is only 20,000. And then you attribute. Siguro ito, 20% likelihood, 70% likelihood, 10% likelihood. And then you get the weighted average. That becomes your ECL na ipipv mo. So, di ba ang bongga? That's how you calculate ECL. No? So, 15 minutes to go. I don't think we can go into detail. However, in a nutshell, that's how you use it. all financial instruments that are subjected to ECL. You have your FVOCI debt instruments and amortized cost debt instruments, plus your receivables and off-balance sheet credit assets or credit guarantees. They are all stage 1. What happens? Under stage 1, you only have to look at the 12-month ECL. What does the 12-month ECL mean? Yung 12-month ECL, ito lifetime. Suppose that the instrument's life is for 5 years. You only have to look at the credit exposure for the next 12 months under stage 1. Kasi the probability, the likelihood of these assets actually suffering from credit losses is low. However, yan. So, pag nag-provide ka against the P&L siya, yung allowance against amortized cost ECL is a contra asset. Yung allowance for probable loss for FVOCI is an equity charge or equity credit. Bakit? Kasi kapag ginawa mo siyang contra asset, the FVOCI balance will no longer tie up to fair value. Eh, ang role is dapat lagi siya naka-fair value. Yun nga lang, lalagyan mo siya ng ECL. So rather than doing the same as amortized cost at magiging contra asset siya, nandito siya. May allowance ka, pero hindi siya tumama sa asset side. Kapag meron kang provision for off-balance sheet items, it becomes a liability naman. Now, at every reporting date, the company performs an assessment to determine whether there is a significant increase in credit risk or SICR. What is this SICR? SICR means that from the point of initial recognition, if the debtor or the financial instrument suffered an increase in credit risk because the credit quality of the issuer or borrower deteriorated as at cut-off reporting date, that those financial instruments are moved from stage 1 to stage 2. The key factor here is SICR. Now, kanina, under stage 1, lifetime is, 12-month ECL. Ito lang yon, pwedeng 1 million pesos ang provision mo. Kung lifetime, it could be higher, pwedeng 6 million. And that's what's required by the accounting standard under stage 2. From 12 months lifetime ECL na kailangan mong tingnan. Kasi you have to look at the entirety. Dahil na tumaas na yung credit risk mo, there is a significant increase in credit risk. You now have to capture that additional risk to the company. Now, wala pang default yun. Increase lang yung credit risk from initial recognition date all the way up to reporting date. If there is actual default na, meaning based on the terms of the contract, dineclared na defaulted yung loan or yung instrument, now it becomes stage 3. Lifetime ECL din, pero yung probability of default mo, kanina 5% sa stage 1, naging 20% sa stage 2, sa stage 3, 100% na yan. Sakto ka, sigurado ka na magde-default yan. Or nag-default na siya. All those provisions are likewise closed against P&L. Now, as mentioned kanina, from 5, yung allowance mo naging 5, naging 20 sa stage 2, naging 45 sa stage 3. Yung interest income mo na you can earn under stage 1 and stage 2 are based on the face amount. Pero under stage 3, you're now forced to calculate interest income under the net amount. Kasi nga, conservative na. Do not overestimate your income, especially if it's already defaulted. Kasi it's highly likely, even if you collect interest, may not be enough to recover for potential credit losses. And locally, under the BSP rules, pag ang asset defaulted na, NPL na, stage 3 na, stop accrual na ang asset, ang company.